Hello and welcome to this new video. Today we are going to cover a very important topic from business valuations, the weighted average cost of capital. Let's start with the definition. The weighted average cost of capital represents the return that a company pays to all its investors, shareholders and bondholders. We know that a company finances itself through equity and debt, bank loans or corporate bonds. The weighted average cost of capital is then the company's overall cost of financing. Formula for calculating the weighted average cost of capital is cost of equity times equity on equity plus debt plus cost of debt times debt on equity plus debt times 1 minus T, and T represents corporate tax. So let's see each term of this formula, starting with the two ratios, equity on equity plus debt and debt on equity plus debt. Let's assume that a company has this structure of capital. 1.4 million in equity and 600,000 euro total debt. So total liabilities and equity will therefore be 2 million euros. And the two ratios that we are looking for are the first 70% and the second 30%. Just pay attention that the value are not book value but market value, both for equity and debt. Now calculate the next term of the formula, cost of equity. In finance, the cost of equity is the return that a company theoretically pays to its equity investors, the shareholders, to compensate for the risk they took to investing in the company itself. So you know that companies need to acquire capital from investors in order to operate and grow. Individuals and organizations are willing to provide funds, but naturally they want to be rewarded. As a general rule in finance, the return must be proportional to the risk taken. So, as a company becomes riskier, the cost of equity rises. How is the cost of equity calculated? It's calculated by using a capital asset pricing model, an econometric model that originated from the portfolio frontier asset theory. Capital asset pricing model actually was developed independently by Sharpe, Lindner and Williams, who won the Nobel Prize in economics in 1990. So this is absolutely not the place to describe the entire theory, but the cost of equity formula is cost of equity equal risk-free rate plus beta times ERP, where the risk-free rate is the rate of return of a risk-free security. In our case, we use either the yield of 10 years Germany bonds or the American T-bonds. If you are calculating the cost of equity in other countries and you decide to capture the country risk, the so-called spread, into the risk-free rate, you have to use the rate of the country's government bonds. Otherwise, you can add the country spread later. Then ERP is equity risk premium, the rate of return required by investors to invest in a well-diversified portfolio of stocks rather than a risk-free rate security. Pay attention to well-diversified portfolio. If you are calculating the cost of equity in a company in a country with a risk-free rate higher than the one in US or Germany, you also have to include into the ERP country default spread, country risk, and the equity market volatility, which is the premium demanded by investors to invest in stock market with a higher volatility than the one in Germany or in United States. On the other hand, if you have chosen to use the specific country risk-free rate that already captures the spread, you don't have to add anything else. The beta formula is therefore the ratio between the covariance of the single stock and its target market and the variance of the market itself. This is the formula. Here you can watch, for example, the beta for the company 8080. Now we have all the elements to calculate our cost of equity. Suppose that risk-free rate is 1.98%, the beta is 1.02, and the URP is 9.73%. So our cost of equity is 1.98 plus 1.02 times 9.73, 11.9%. And now the cost of debt. Public companies have an official debt rating, but private company doesn't have it. So cost of debt is risk-free rate plus a spread proportional to the volatility of the expected return of the industry equity market and plus a default spread associated with the country. So where can you get the volatility number? By knowing the standard deviation of the volatility of the expected returns for the industry. But anyway, where do we get the data? Some data are easily available. For example, beta is indicated among capitalization data in public companies and many specialized websites. Other data are available from publications such as, for example, Cost of Capital by Duff and Phelps, but a great amount of up-to-date data are provided free of charge by Professor Damordan in his tables. Practical example. So we already know that in the previous example the cost of equity was 11.90% and the ratio equity on equity plus debt is 70%. Let's assume that the company operates in the entertainment industry and that the standard deviation of the stock market is 30.07%. So now, by using this table provided by Professor Damordan, the spread to be added to the risk-free rate is 1.72%. If our company is based, for example, in Italy, we also know that the global default risk for Italy is 2.69%. Since interest expenses are deductible, the cost of debt must be discounted using the value 1 minus T, which T is the corporate tax rate. In Italy, corporate tax rate is 27.9%, so we have cost of debt is 4.57% after tax. We can calculate the weighted average cost of capital, which is 9.7%. If our company is a public one, we can directly use this rate to discount the net cash flow to obtain the value of the company net present value. But if, on the other hand, our company is a startup or a private company, we must take into the account three more factors. The first is the most important one, because in the capital asset pricing model we assume that all the risks are spread away by diversification, and the only risk that still remains is the systematic one. But by operating with private company or startup, it's absolutely impossible to them to completely spread away all the risk associated with the business ongoing. So we have a portion of the unsystemic risk that must be taken into the account, and we do that by using the total beta instead of the market beta. The second factor is a startup risk, because a startup is a riskier stage of a firm, and we must, if you are evaluating a startup, you must add another coefficient of risk, and the last factor is the illiquidity risk. So that's all for this video. As always, I would like to thank you, those who follow us, those who subscribe to our channel, and see you next week.